back, we're dealing with the partnership realizes tax items, items of tax gain, income, loss, deduction, or even credits. We don't focus on credits much in this class, but tax credits also would be recognized by the partnership, and those allocations flow through to the partners to be reported in their own tax returns. And 704 deals with the question of, well, which partners get allocated which. And we know that the approach that we're going to take in general is going to be to, number one, determine where the partnership agreement says items are allocated. And then number two, test those allocations for substantial economic effect, the safe harbor, the substantial economic effect safe harbor, because if they satisfy the safe harbor, then they will be valid. They'll be respected by the IRS. If they are outside the safe harbor, then we have to allocate according to the partner's interest in the partnership, PIP, which in some cases can be quite uncertain. And then with substantial economic effect, we've spent a couple days on economic effect, and we're finishing that up now. Economic effect is focusing on whether the allocations have what we can call sort of pre-tax economic effect. If you get allocated income, is that meaningful to you? If you get allocated loss, is it meaningful to you? Is it tethered to the economic deal, or is it just tax? An economic effect makes sure that it's not just tax, in the sense that it's assuring that if you get allocated income, your capital account goes up, and your capital account going up has to be a good thing. And then if you get allocated loss or deduction, your capital account goes down, and your capital account going down has to be a bad thing. That's the general idea. And then the two tests for economic effect, the general test is quite simple because you're just looking at the partnership agreement, has to satisfy the big three. If not, then your next step would go to the alternate test for economic effect, and that's a bit more realistic in many cases because the third prong of the big three requires partners to restore deficits on an unlimited basis, and that's typically a non-starter for limited partners. And so the alternate test in general can get a little bit complicated, as we saw, but in general what the alternate test is doing is it's saying, do you have the first two of the big three, and does your allocation, so if the answer is yes, then you move on to the next inquiry, which is, does the allocation drive your capital account? Would it drive your capital account below zero? If the answer to that question is no, then your allocation has economic effect in an alternate test. To the extent it is yes, then your next question is going to be, well, do you have a limited deficit restoration obligation? We know you don't have an unlimited one, because otherwise we wouldn't be in the alternate test. Do you have a limited one? And a limited deficit restoration obligation, as we saw, can be just a DRO that's capped. It could be an obligation to contribute money in the future, or property in the future, to the partnership. It could be a promissory note that you give to the partnership. And then the last thing we left off with is probably the hardest one to sort of conceptualize, but again, I think it's perhaps intuitive. Let's go to the reg. This is 1-1B2 toolized D, the alternate test, 1.704-1 B2 toolized D. Down here in the alternate test. And this is the anticipation part. In determining right here, this introductory language. So in determining the extent to which the previous sentence is satisfied, the previous sentence is saying, see how whether the allocation would drive you into a DRO situation, into a deficit balance situation. You adjust the partner's capital account So again, this is a hypothetical adjustment, and you sort of anticipate, you take into account, you accelerate for this purpose these distributions. Distributions in the future that are reasonably expected to be made to the extent they exceed offsetting increases such partner's capital account. So again, this is going to refer to generally distributions of borrowed proceeds, because when you borrow money, you don't increase the capital account. If you're distributing profits, then the profits are going to increase capital accounts. Now, it's possible you could be distributing profits in a way that you're different than you're allocating. So there could be complicated situations where this could arise, but we're talking generally about distributions of debt proceeds. And then, so you're getting out in front of these reasonably expected distributions, and you're creating a cushion in your capital account to make sure that when the distributions happen, they don't drive you below zero. We're all worried about, getting a partner who shouldn't be below zero in a capital account into a below zero capital account situation, because that's where it's just non-economic. It just doesn't make any sense. So we try to get out in front of it when we can, and then finally that intuition also helps us to understand the QIO, which is a condition of being in the alternate effect test. And well, this sentence here tells us what a QIO is. A QIO provides that a partner who unexpectedly receives an adjustment, allocation, or distribution described in 4, 5, and 6. Again, you can strike out 4 and 5, then you can strike out 4 and 5. We're not going to be dealing with that stuff. But 6, who unexpectedly receives a distribution described in 6. So this is, you couldn't anticipate it. It was not reasonably expected. Let's say at the end of the current year, we're using our crystal ball and we say, again, really your accountants, the accountants are going to say, all right, do you see any distributions next year, out of borrowing proceeds or the like? And you say, well, no, anything could happen. It's possible. But as of this moment, I don't foresee that. That doesn't seem like it's going to happen. And then the next year happens, and lo and behold, interest rates drop, or your property goes up in value, or banks approach, and you say, that's a pretty good time to borrow some money and distribute it. Well, that would be an unexpected distribution. Then if that drives your capital account negative, you then will be allocated items of income and gain in an amount and manner sufficient to eliminate such deficit balance as quickly as possible. So we're going to specially allocate income and gain to get your capital account, which shouldn't be below zero, which now is because of this unexpected distribution. We're going to allocate you amounts of these positive items as quickly as possible to get you back up to zero. Or if you have a DRO, up to your DRO amount. And we saw that in the examples, example 1, so we know the examples are in 1.704-1B5. Example 1, which we've dealt with a lot, example 1, 6 little i's, is the example that illustrates how you anticipate these distributions. It doesn't, the examples don't show you how to do a QIO. We're going to do a QIO in the review problems that we're going to do on Wednesday. Hopefully, if we get, depending on how long it takes today, we may not get fully there on Wednesday. But the next topic, so we're doing substantiality today, and we have a set of review problems for substantial economic effect, and so we'll see a QIO there. Okay, and that's all sort of review from last couple classes. Any questions at this point on any of this? Okay, well, now we have to go to substantiality. So once we have economic effect, then we move on to substantiality, and that's found in -1B2, 3 little i's, right here. Before we get into the details, and this is more difficult regulation language that we'll be dealing with, let me try to explain what the problem is here. And the problem here starts with, you say, okay, well, that makes sense that we have allocations that have, we're going to make sure they have economic effect. We're going to make sure they're meaningful. They go up and down appropriately, and then they affect capital accounts, which then are meaningful upon liquidation. That makes sense. But then, and again, what we're trying to deal with here is a situation where someone gets allocated items just for tax purposes. And so let me use a simple example here. So let's say we have two partners, they're 50-50 partners. We've got one partner as an individual. Partner is an individual. One partner is a C corporation. Okay, and they're 50-50 partners. And the partnership is going to realize, say, 100 of ordinary income and 100 of long-term capital gain. And under the base case, under this, where we start with, let's say everything's going to be allocated 50-50. They're perfectly equal. And so what would happen then is 50 would be allocated to the individual, 50 to the corporation, and same thing with the long-term capital gain. These all have economic effect. They're affecting capital accounts, and capital accounts are meaningful. So that wouldn't be a problem. And looked at in isolation, well, let's keep it there. So then a clever tax lawyer comes in and says, well, wait a second. The tax lawyer says, well, C corporations, they don't have a capital gains preference. So C corporations, they pay tax at the same corporate rate of 21% now on long-term capital gains or ordinary income. Meanwhile, individuals have a very significant long-term capital gain preference. So they say, well, why don't you change the deal, change the allocations, and give the individual, give the corporation all the ordinary income, and give the individual all the long-term capital gain. We're netting these out, we're plus 100 in the capital account, plus 100 in the capital account, or plus 100 in the capital account, or plus 100 in the capital account here. And if this is respected, what you've done is you haven't, you've basically shifted 50 of ordinary income from individual to corporation and shifted 50 of long-term capital gain over. Now these have economic effect because by themselves, they increase capital accounts and capital accounts are meaningful. But they are shifting around the character and they're just being offset. And so you end up with a situation where in context, they're not really doing anything. So this is a tax lawyer playing the game to sort of say, okay, well, your capital accounts are meaningful. That's fine. I'll just create sort of offsetting allocations. And I could do it with losses as well. But anyway, the idea here is that the corporation is indifferent because the corporation pays the same tax rate on these, and the individual is now better off because the individual has 50 of an extra 50 of long-term capital gain instead of 50 of ordinary income. Let me do one other example here. And without a substantiality, you could just play this sort of game of shifting, offsetting allocations. So let's say you have taxpayer with no NOL, and now you have a taxpayer with an NOL. And the NOL is expiring in year 2. Okay, and in year one, we expect to have 100 of losses, and in year two, we expect to have 100 of income. Again, under the default, if this is 50-50, we would allocate here, here, and there, and there. We net out to 0. But now you're giving this taxpayer a loss that taxpayer doesn't need because the taxpayer's got NOLs. So taxpayer with NOLs that are going away don't really help the taxpayer. I'm not going to save the taxpayer any money. So again, clever tax lawyer comes in and says, okay, why don't we allocate all the loss in year one to no NOL, no NOL. We'll call this TN with the NOL. Nothing, TN. Then we'll allocate all the income in year two to TNOL, and then nothing there. And again, it all nets out the same. We're in the same place. But what have we done? Well, we've given this taxpayer who cares about losses more losses in year one, now more income in year two. But again, due to time value of money and such, the taxpayer is going to take the extra early loss because it's going to save it's this taxpayer taxes on a present value basis. Okay, and we're just using, again, sort of offsetting allocations. We're going to shift an extra 50 of loss here, and then we'll shift another 50 of income there. Everyone ends up in the same place. We just save some taxes. And again, so while one way to look at it is economic ethics is looking at sort of the allocations on a individual basis, to sort of myopically focused on this. Does this allocation increase your capital account, decrease your capital account, and then capital is meaningful? And then substantiality broadens the scope and says, well, we understand that people can just create offsetting allocations or allocations that are playing around with character and not just the amount. So to deal with that sort of tax planning, the IRS and Treasury have created these substantiality rules trying to get at this problem. And this becomes a more significant conceptual problem and also practical problem. Whereas the economic effect tests are pretty straightforward. Substantiality gets into more crystal ball prediction stuff. We saw a little bit of that with the alternate test, but now in substantiality, we're getting into a huge issue where we have to look into the future. But we have to have something like substantiality. If we just let people do this, people would come together with different tax attributes and just exploit the hell out of the fact that we could just basically allocate certain types of income there and allocate other types of income to the otherwise. And, you know, again, it would be a tax planner's dream to just play these games, which would be bad from a tax policy perspective. We have partnerships that are formed because of tax reasons, and not because of business reasons. And number two, we would then be reducing government revenues and have to make them up elsewhere. And one way to think about it is that we can't sell in our tax system, we can't sell our tax attributes. This guy with the big NOL can't sell the NOL to this guy. What substantiality is doing is it's saying, well, we know people could try to do this through a partnership. And so we're not going to let you sell it, and we're not going to let you effectively sell it by using partnership allocations. That's really what we're dealing with here. There could be a different system where we just let you sell your attributes. But then that's a different system. That would mean less taxes collected. We have to raise it, the tax somewhere else. But it doesn't seem to make sense that you would say, well, you can't sell your tax attributes through a simple sale, but you can use partnerships to sell. Okay, let me stop there and take any questions on comments on any of this stuff. Substantiality. It'll become more clear as we do these problems. Let's take a look at some of the tests then. Let's go back to the regs. And there are, let's go back to the reg here. There are 3 tests that we have to worry about here with substantiality. I'm going to start with the simplest one. And if you go through here, well, we'll go through here a little bit, but here are some, this shifting, this is -1 B2 3 little i's B, the shifting tax consequences. This is the shifting test. It tells us the economic effect of an allocation or allocations. I don't know why they say it's always going to be a pair of allocations at least. So I can't think of a situation where it's a single allocation. You're generally talking about pairs or more of allocations, but whatever, the allocation not substantial if at the time the allocation becomes part of the partnership agreement. So that's one thing that we have to note here, that we're testing for substantiality at the time the allocation becomes part of the partnership agreement. For economic effect, we're testing generally at the end of the year to which the allocation relates. That's the significant time. For alternate effect, does it drive our capital account below 0? But here, we actually have to focus on the situation at the time the allocation has become part of the partnership agreement. So if there's a single partnership agreement that's never been amended, so you have a partnership agreement that and the allocation never been amended, you're going to test this at day 1, or when the partnership agreement is signed. If the partnership agreement is amended and the amendments relate to the allocations in question, then you're going to look at the date the amendment is executed. So you're looking at that there's a strong likelihood, and then you have these 2 conditions. The net increases and decreases will be recorded in the partner's respective capital accounts for such taxable year. So that's one thing to note. We're talking with shifting, we're looking at a single taxable year. So those net increases and decreases will not differ substantially from the net increase and decrease that would have been recorded in the partnership capital account if such allocations were not contained in the partnership agreement. So if the allocations were not contained in the partnership agreement, this is asking, would the capital accounts end up in the same place, nearly the same place, differ substantially, not differ substantially. So again, a before and an after picture. So a baseline, how would these allocations be made in the absence of these special allocations? And what do the capital accounts look with these special allocations? And compare those 2. And then we have to ask, so if there's no substantial difference in those capital account balances, then we also have to ask the second question, which is, does the total tax liability as a partner go down as compared to the baseline? So baseline allocation scheme, compare the capital accounts situation to the baseline scheme, and then compare the total tax liability of the partners under the baseline scheme and under the special allocation scheme. So again, that's very abstract, I know. And so let's go to a problem. This is either in the -1B5 example, -1B5. We did example 1 a whole bunch. Now we're going to go to example 6, -1B5, example 6. Here we got K and L. They're equal partners in a general partnership. So here, what's nice about these examples, and in the real world, this can get really tough. The baseline pretty much jumps out at you. They're equal partners. It's 50-50 baseline. And then we have an amendment of the partnership agreement. So that's pretty much jumps out at you. We're amending the partnership agreement from 50-50 to have special allocations. So our baseline is 50-50. And the complicated thing here, again, this goes back to tax 1, and you just have to sort of understand the game here. Just for this problem, I'm not going to test you on section 1231 in the exam. But in 1231 is a sale of business property. And 1231 gains and losses are netted at the end of the year. And if your 1231 gains exceed your 1231 losses, then all of those are long-term capital gains and losses. If your 1231 losses, on the other hand, exceed your 1231 gains, then all your losses and gains, 1231 losses and gains, are ordinary. So the character of a 1231 loss depends on your 1231 gains. And we know that you could have 1231 gains and losses directly by a business you're operating directly, or it can have flow through. You can have 1231 gains and losses recognized by a partnership or S corporation that flows through to you. So in order to know whether a 1231 loss is going to be allocated, is going to be capital or ordinary, we need to know the partner's individual tax situation. So here what it says is that K expects to have no 1231 gains during the taxable year. So for K, who's not going to have 1231 gains, all 1231 losses to K are going to end up being ordinary losses to K. And taxpayers like ordinary losses better than capital losses for 2 reasons. One is that capital losses can only be used to the extent of capital gains, the capital loss limitation. And then another 3,000 is ordinary income. We can just ignore that 3,000 because that's not meaningful generally if we're talking about millions of dollars of capital losses. So that's one reason. The second reason, even if you can use capital losses, they will absorb capital gains. And long-term capital gains are taxed at a low rate. So ordinary losses are not limited by the capital loss limitation rule, and they will sort of soak up ordinary income first, high rate ordinary income. So just like taxpayers prefer long-term capital gains over ordinary income, the inverse is true. Taxpayers prefer ordinary losses over capital losses. So K, they're going to allocate to K this 1231 loss to K, and we're going to allocate an equivalent amount of other partnership loss to L, who is going to have 1231 gains. So let's see how this works. And for an example, we got K. So here's our baseline. Got K and L. Let's assume there's 100 of 1231 loss and 100 of, let's call it, capital loss. So the baseline would be just allocate this 50-50. And now with the special allocations, allocate all of the 1231 loss to K and all of the other loss to L. So does this work? So under shifting, we say, okay, the capital accounts differ substantially. They don't differ at all under these facts. They're the same. Question 2. Is the total tax liability of the partners reduced? Well, this requires us to characterize and figure out what's going to happen here. So what's going to happen here is K, who has no 1231 gains, this is going to be an ordinary loss because K's 1231 losses exceed her 1231 gains. L, who has 1231 gains, assuming they exceed her 1231 loss, this is going to be a capital loss. And of course, this is a capital loss, and this is a capital loss. With the special allocations, again, this is going to end up being an ordinary loss because K has no 1231 gains, individually or through other partnerships. And L is going to have a capital loss. So now we ask, is the total tax liability of the partners reduced? Well, L is in the same exact place, right? L has no difference. K has effectively converted a capital loss into an ordinary loss. So K's tax liability is going to go down because even if she can use this capital loss, assuming it's usable against long-term capital gains, it's going to reduce her taxes less than the extra 50 here that'll reduce her high rate income. So these allocations will lack substantial economic effect under the shifting test. And they get reallocated under PIP, and it's pretty simple here that you basically would allocate everything 50-50 under these facts. Questions on that? Now, one problem here, one issue here is the tells us one key fact in the example. There's this, this crystal ball fact that we actually kind of glossed over, but now we'll focus on it. At the time the partnership agreement was amended, there was a strong likelihood that there will be enough non-1231 loss to fully offset. So this sentence right here. And what that means is we assumed here there's going to be at least, the same result would occur if the capital loss is like 110. We would just, the first 100 we give all to L, and then everything else gets split 50-50. We assumed there was enough of an offsetting amount to fully offset. But what if there's some uncertainty? What if it's possible that there's only in, let's say, 80 of other loss? Say there's 100 of 1231 loss and there's only 80 of other loss. But what happens then? What do things look like then? So there's only 80 of other loss. So all we got here is a 1231 loss of 100 and an 80 of capital loss and no other losses. We'll get under the baseline, we give 50 of each of this and 40 of this and 90 90. With the special allocations, K would get all 100 and L would get all 80. Now we compare. Now the capital counts aren't identical. They differ. One question would be whether they substantially differ. But what this shows you is that if there's enough variability in the potential for this capital loss, if there's a real good possibility that the loss could be significantly less than 100, then this allocation will pass the shifting test, because it's not strongly likely that the capital accounts will end up reasonably close. So there's a trade-off here between risk. If you take on more risk, you can play these games. Here, K runs the risk. K is trying to get this big tax benefit, but runs the risk that his capital account is going to be a lot lower. And what if there's zero capital loss? Is that a possibility? Then things look way different. If it's zero, then it would have been 50 and 50, and instead would be 100 and 0. A's capital account is way lower. So to the extent, you're locked in to just getting a tax benefit and not having really any significant effect other than tax, then you can't do it. But if there's enough variability, enough risk, then you can play these games. But then you're taking on this pre-tax economic risk. Okay, so that's shifting. We asked, do the capital accounts end up close to where they would have been under the baseline? The answer is yes. Then we asked, do the partners' capital accounts, the partners' tax liability in the aggregate go down? We just add up their tax liability. Does it go down? The examples I gave before, I used an example with we had an individual and a corporation, and we had 100 of OI and 100 of long-term capital gain. And I'll put the baseline, well, I'll put the baseline in black. So it would have been 50, 50, and 50, 50. That's the baseline. And the clever tax lawyer, clever in a way to sort of play these games, but not clever enough to realize they don't work, would have say, okay, let's give all the ordinary income to the corporation. Because corporations don't have a capital gains preference. Let's give all the long-term capital gain to the individual who does. And again, capital accounts would have been 100 and 100 on the baseline, and they're going to be 100 and 100 after these facts. So capital accounts are in the same place, and then we asked the tax liability go down. Well, again, the corporation has 100 of taxable income either way, no preference. So corporation's tax liability is the same. The individual goes from having 50 of OI and 50 of long-term capital gains to having 100 of long-term capital gains. So the individual shifted 50 of ordinary income to 50 of long-term capital gains. That's going to reduce individual's tax liability. So this would flunk shifting as well. Now, again, if there's enough risk, if we said, okay, all OI goes to individual, all long-term capital gain goes, all OI goes to corporation, all long-term capital gain goes to individual, and there's a real possibility that these could be substantially different, then this can pass muster. Because then the capital accounts could end up wildly different. But if we say, let's say the first 100 of each flip over, and there's a strong likelihood that they're going to have, that the partnership will have at least 100 of each, then it's not going to work. Okay, stop with questions on shifting. Okay, let me, so you might say, well, that's pretty hard to do. You got this crystal ball, and there is a rule here, back to the shifting part of the test. So we have the first sentence of B here is the shifting test. The next sentence is known as the hindsight presumption. And we're testing when the allocation becomes part of the partnership agreement. So if it's an amendment, a prospective amendment of the partnership, let's say on December 31 of year 0, we're amending the partnership allocations for years 1 and 2. We got to put ourselves on December 31 year 0 and look forward. But we have this hindsight presumption here. This long sentence, which I'll summarize, which says, look, if it turns out that the capital accounts did not substantially differ and the total tax liability went down, then it will be presumed that those were strongly likely to occur, though the partners can try to rebut that presumption. It's a rebuttable presumption. Sort of puts the partners on the burden to sort of say, yeah, it just so happened to work out this way. Didn't it work out great? You know, we ended up in basically the same place and we reduced our taxes. But even though that happened, it wasn't strongly likely to happen. And here's why. Yeah, we just got lucky. That's called the hindsight presumption. Sort of gives the IRS a fighting chance. And again, what taxpayers would do if they're trying to play this game with risk is they would, you know, have spreadsheets and the like dated December 31 year 0 that would show, yeah, there's lots of different things that could happen. And it wasn't sort of locked in to be just a tax play. And that mitigates the tax planning. Again, the optimal tax planning is one where you change the deal, change the tax consequences without changing the deal. When you add a bunch of risk, you're now changing the deal. And so the idea is that hopefully this would deter a lot of this tax planning. Okay, any questions on shifting? Okay, transitory is very much like shifting, except now we're expanding the scope and we're not just looking at a single year. So shifting, the offsetting, all happens in 1 year. In transitory, the offsetting can happen over a number of years. And so it's the same language you'll see with shifting. We're just using, it can be multiple years. So the intro is exactly the same, but now it's for the taxable years. We're looking at capital account adjustments for the taxable years instead of the taxable year, such taxable year. So instead of this, we're doing taxable years. And we have the same hindsight presumption here. So remember that example, let's go back to the example I used with the NOL, where we had the NOL partner and the non-NOL partner. So we had the no NOL partner and the NOL partner. And we had 100 of loss in year 1. $100 of income in year 2. And on the baseline, we're going to give everything 50-50. Baseline, special allocation. And with our tax lawyer comes in, says, okay, just why are you giving losses to the NOL partner? They don't need losses. Give them all here, and then we'll offset it over here. Well, this illustrates why shifting is not enough. We can't just do shifting, because shifting, we stop the music at the end of each year. At the end of year 1, the capital accounts look a lot different. We're just comparing this to this and that to that. That's a big difference. Same in year 2. Just year by year, this looks a lot different. It's only when we combine year 1 and year 2 does it end up being the same. The capital account adjustments net to 0, year 1 and year 2. Here, they also net to 0. So the capital account, under these sets of facts, the capital accounts are in the same place. Does the tax liability of the partner go down? Yeah, it goes down. One way to see this is that this partner here has 50 of income in year 2. Remember, the NOLs were going to expire then. And so now this guy's got 50 of income in year 2. He doesn't have any income allocation in year 2 with the special allocations. Just basically extending the NOL effectively beyond its period. And remember, the fact that he's got a 50 extra loss here is irrelevant because he's got this big NOL. So his tax liability is the same in year 1, 0. It's going down in year 2. The non-NOL partner, it's a little bit less intuitive what's going on with their tax liability. But if the rates are the same, tax rates are the same, then the tax liability for the partners is going to be the same, the aggregate tax liability. It gets trickier if non-NOL partner tax rates went up in year 2. That would be from where year 1, that would make things more complicated. But the easiest thing to see here is that this is really getting basically a 50 of extra deduction for NOL partner. Okay, that makes sense. So let's look at a problem. So this is let's look at 1.704-1B5. So example 6 was a shifting. We're going to do example 7 as an example of a transitory test. Let's turn there. So we've got M and N, partners in a partnership. The big 3 is satisfied. So the partners are going to invest in tax-exempt stock, tax-exempt bonds, and corporate stock. And this was before dividends were preferentially taxed. So this is back when dividends were ordinary income. So there's going to be ordinary dividends and tax-exempt interest that are generated. And M is expected to be in a higher bracket than N. This is important. We need to know a lot about the partner's individual tax attributes to do this analysis. It's the interplay between the partner's individual tax attributes and the character of the income. So if we ever have a problem where I'm starting to tell you a lot about the taxpayer's individual tax attributes, that is a red flag that substantiality may be at issue. If you don't know their tax attributes at all, then it's not a substantiality question, because you can't see whether tax rates go down or up. But here, again, M is higher bracket than N. And what they're going to do is they're going to give M, the high bracket, disproportionate amount of the tax-exempt interest. And M is going to get allocated, N, I'm sorry, is going to get allocated an equally disproportionate amount of dividend income. So again, we're given the zero rate income to the high bracket. We're given the ordinary income to low bracket. And here's the key fact. That's in the agreement. The crystal ball is going to be, well, okay, what are the relative amounts of tax-exempt income and dividend income? Giving someone a disproportionate amount of one type, that doesn't necessarily mean you've got a problem. But if the amounts are going to be substantially the same, substantially equal, then they're going to offset. Actually, I'm sorry, this is dealing with the gain. It's not the key part. This problem is saying the gain is not, the gains could differ, but that's not what, it's this. This is the strong likelihood that the tax-exempt interest and the taxable dividends will be not differ substantially. And again, this means that the implication here is that from year to year within the 3-year period, in year one, they might differ substantially. If you're looking at any particular year, they might differ substantially, but over the 3-year period, they're going to be the same, roughly. And the conclusion, therefore, is that the allocations are going to fail the transitory test, because at the end of the 3-year period, the capital account adjustments from the dividends and tax-exempt interest will be roughly the same over that 3-year period. And the taxable income will go down. High rate income, high rate taxpayer is sheltering high rate income. So the shelter now, which would have been 50%, well, I'll draw it out here. Let's say we have the facts are consistent with something like this. So we've got high, low. And we'll do the baseline. Let's say in year one, we only have dividends. In year two, we only have tax-exempt interest. And in year three, they're the same amount, let's just say. So under the baseline, we would have given 50 and 50, 50, 50, 0, 0. And with the special allocations, we're going to give 90% of this here, 90, 10, 90, 10. So notice that, again, if we stop the music at the end of year one, shifting isn't going to catch this. because we stopped the music at the end of year one. Instead of having a 50 plus 50 capital account adjustments, high is going to have plus 10, and low is plus 50 to plus 90. Those are going to differ. And so we need to expand the scope. It's only when year two comes into play do we realize that these offset. And again, this is perfect offsetting because the capital account adjustments are exactly the same. Again, we're comparing that to that, that to that. They do not substantially differ. Does the tax liability of the partners go down? Let's assume high is in a 50% bracket. Let's assume low is in a 10% bracket. Well, the total tax liability for high is under the base case is going to be 100 times 50%, which is going to be tax of 25. I'm sorry, tax of 50. So this is good. I'm sorry. That'll be taxable. This won't be. So that's tax of 25 under the base case. We're turning that into tax of 5. So high bracket has reduced taxes by 5. Remember, this is not taxable. Low bracket is going from tax of 5 10% on 50 to tax of 9 10% of 90. So high bracket is saving $20 of tax. Low bracket is increasing tax by 4. The net tax savings is 16. So their total tax liability goes down by 16. That's the 40 of shifting from dividend to tax exempt times the delta of 40% of the tax rate differential. So if you wanted to see where that came from. But we don't really care so much about the precise dollars. We just know the total tax liabilities went down because high bracket is saving more by shifting from dividend to tax exempt, and low bracket is increasing tax by shifting from tax exempt to dividends. Okay, so the bottom line here is that these allocations will lack substantial economic effect substantiality under the transitory test. They're fine under the shifting test, but they fail as transitory tests. You only need to fail one until it's failed. So that's what this conclusion says. It's not substantial because there's a strong likelihood that the capital accounts will be the same and the tax liability is reduced. Two little eyes, you can go through this on your own time. It's just changing. It's going to do a 90-10 only for the first 10,000 of each and only for the first taxable year. So it takes us back to shifting. So 2 little eyes, 7 2 little eyes is another shifting problem. And it assumes that there's going to be sufficient more than 10,000 of each. So if you're shifting just the first 10,000 of each, and there's going to be at least 10,000 of each, then capital accounts are going to be identical. 3 little eyes then adds to that and says, let's assume there's not a strong likelihood that they'll earn 10,000 of each. And that the amounts could be different from each other substantially. Well, in that case, the allocations will be substantial. There won't be a shifting problem because of that variability. Okay, so again, transitory shifting, they're kind of cousins of each other. You're asking, oh, do the capital accounts end up in the same place compared to the baseline? And if so, does the total tax liability of the partner reduce? Are they reduced compared to the baseline? If the answer is yes to both, then you fail the test. The only difference between shifting and transitory is shifting, you're just looking at one taxable year. Transitory, you're looking at over a period of taxable years. And it'll pretty much jump out at you which one you use. Again, if the potentially offsetting items are going to all occur in 1 year, then it's just shifting. If the potentially offsetting items are going to happen in more than 1 year over a period of years, then you use transitory. Okay, questions? All right, the last substantiality test, I said there were 3, is found in the intro. Let's go back to -1, B2, 3 little i's. -1, B2, 3 little i's. Okay, we can go through this now. So the first sentence, there's a little bit of a debate of whether this has any meaning at all. I view this as basically throat clearing. So I don't think it has any real effect. So you can sort of ignore that first sentence. The next sentence is another test. So this is the after-tax test. Some people call it, the book calls it the after-tax test. Some people call it the overall tax effects test. In some respects, it's a little bit easier to understand. So it says, notwithstanding the preceding sentence, the economic effect of allocations is not substantial if at the time the allocation was part of the partnership agreement. So again, we're looking forward. If it's a prospective amendment to the partnership agreement, you're going to use a crystal ball and try to figure out what's going to happen in the future. And it has 2 prongs, but we'll see really just one is important. One, the after-tax economic consequences of at least one partner may, in present value terms, be enhanced compared to the baseline. So at least one partner may be better off as a result of these allocations on an after-tax present value basis. Now that's really, I think, meaningless because of course, someone has to have the potential to be better off on an after-tax basis when you amend the partnership agreement. It's almost impossible to think of a situation where everyone can only be worse off. I mean, I guess you could have a situation where something's like where it's meaningless, but again, even why go to the trouble if it's meaningless? So it's the second part. I can clean this up. If you really want, it's this prong that we really need to focus on. There's a strong likelihood that the after-tax economic consequence of no partner will be substantially diminished. So we put that together, you're saying at least one partner could be better off, and no partner will be substantially worse off. Sort of everyone wins, or at least nobody loses. And as a result, the inference is that the government's going to lose. So again, a lot of the fact patterns that I've described thus far, that we've already described, would also fail the overall tax effects test, or this after-tax test, whatever you want to call it. So when we shifted the 1231 loss to the partner that doesn't have 1231 gains, that would have been a problem here too. It failed the shifting test. It's going to fail this test too, because the partner that shifted that 1231 loss, that got the extraordinary loss, that partner was better off. The other partner, who was just getting capital losses anyway, is no worse off. A corporate partner example, where at a corporate partner with and individual partner, and we gave the ordinary income to the corporate partner and the capital gain to the individual partner, the corporate partner wasn't worse off because converting capital gain to ordinary income didn't hurt that partner because there was no capital gains preference for corporations. But the individual partners was better off on an after-tax basis. So in a lot of cases, these are duplicative. We're going to see next class, because we're not going to get there, where they're not duplicative. Situations where they're captured by this test that wouldn't get captured by other tests. So again, we're asking, is any partner worse off? Can any partner be worse off after the, compared to the baseline on an after-tax present value basis? And this again comes down to risk. If no partner can be worse off, there's no risk of that, then it's just a tax play. That's the idea. The next sentence says, in determining the after-tax benefit, the tax consequences result from the interaction of the allocation of partners. Tax attributes that are unrelated to the partnership will be taken into account. Well, that's obvious. For all of these, the interaction between the partners' tax attributes and the tax item in question are key. Another way to say this is if all partners are identical from a tax perspective, if everyone's a high rate individual, all partners are high rate individuals with no special tax situation, you're not going to have substantiality problem. You're not going to have a substantiality problem because you're not exploiting these tax differences. That if one partner, if you're shifting ordinary income from one partner to another, that partner is going to be worse off, the one that gets more ordinary income. And the tax liabilities of the partners aren't going to go down because you're just moving the tax liability from one partner to another. It's only when you have these different tax attributes that you're exploiting do these issues come into play. Questions on the after-tax test? Well, the example that covers this is example 5 in the -1B5. So let's turn to -1B5, example 5. We're not going to have time to go through this today. But I'll foreshadow it. So we've got I and J are partners in a partnership. And again, we're telling you a lot about their personal tax situation. I is going to be a 50% bracket payer, and J is going to be in a 15% bracket payer. Bracket. High bracket, low bracket. There's going to be tax exempt interest, and the range is going to be 450 to 550. That's tax free to whomever it gets allocated to. And we're going to have 450 and 550 of taxable interest and dividends. And again, this was back when dividends was just ordinary income. So we have tax exempt income, and we've got ordinary income. And the ranges that are expected are shown, 450 to 550. And this next sentence tells us a little bit about the baseline. They contributed equally, they're sharing in gains and losses equally. So the baseline kind of jumps out at you, that the baseline is 50-50. And they're going to allocate, instead of allocating the tax exempt interest 50-50, they're going to allocate the tax exempt interest disproportionately to I, high bracket payer, and they're going to allocate the ordinary income disproportionately 100% to low bracket partner. So that's what they're going to do. And because the disproportion is not the same, the capital accounts are going to could be quite different, as we'll see. So this is where shifting isn't going to really help us here or help the government here. because when you run the numbers, the capital accounts could be wildly different than the 50-50 baseline sharing ratio. Even though the amounts are going to be the same, roughly the same, the sharing is, you know, I only gets 80% instead of 100% of the tax-exempt interest. And there's some range here. There's some variability where we'll see the capital accounts could be sort of wildly different. So the partnership agreement, this is next, just says this is the big three is satisfied. So this is what it tells you. It's just a substantiality issue. Economic effect is fine. And so then we go through the analysis. And what we'll do on Wednesday, we'll do this problem. I encourage you to fight with it a little bit. But what we're going to do is we're going to say, okay, we're really looking for, is there a possibility that any partner could be worse off? So we're going to compare to the 50-50 baseline. Is there any chance that any partner could be worse off? And so what we can immediately do is kind of jump to the likeliest chance that someone will be worse off. And so because high bracket is receiving disproportionately low amounts, 0% of the ordinary income, and disproportionately high amounts of the tax-exempt income, the worst case possibility for high bracket payer would be that there will be the maximum amount within the range of ordinary income. So 550 of ordinary and the lowest amount of tax-exempt interest. So if high bracket's going to be worse off, it's going to be under that permutation. Is the most, it's going to be the worst, the highest chance of being worse off. We flip it around for low bracket. Low bracket is getting 100% of the ordinary and only 20% of the tax exempt. So for low bracket, the worst case scenario, or the highest chance of a worst case scenario, is going to be where the tax exempt interest is the highest and the taxable, the ordinary income is the lowest. And so what we can jump to the worst case scenarios and see whether any partner is going to be worse off. And that'll be the application of the after tax effects test. So we're in the middle of that. We're going to do example 5 and do a few other things. We're kind of in the middle of this assignment. So then Wednesday we would do the review problems. Let me just say then that to be safe, what I would do is I would prepare problem 1 of the review problems, because but I don't think we'll get beyond problem 1 of the review problems on Wednesday. So we'll finish up substantiality, struggle with this example, play around with the example, see if you can get it. The book also goes through this example. And we'll say a few more things about substantiality, and then we'll move on to that review problem, where we'll have another opportunity to go over all this stuff, including substantiality, another time. Okay, any questions? All right, well, with that, I'll see everybody on